If you want to know where the biggest money is usually made, do not look where the public is staring. Look where the public is too distracted to stare. That is one of the oldest rules I know, and it keeps proving itself in new costumes. A war starts, oil spikes, politicians start talking like civilization might end before sunrise, and ordinary investors do what ordinary investors always do when fear gets theatrical. They pull back, they freeze, they tell themselves they are being prudent. They wait for the smoke to clear and for somebody important to give them permission to think again. Meanwhile, the real capital cycle keeps moving underneath them. That is what I think is happening right now. Everybody has been glued to Iran, to Trump, to ceasefires that may or may not hold, to one-day plunges and one-day relief rallies, to the feeling that the entire market has become a hostage to whichever geopolitical headline happens to arrive before lunch. I understand that feeling. Short-term markets are often ruled by emotions attached to variables none of us can control. But I have spent too much of my life watching money move to mistake the noise for the engine. The engine is somewhere else. The engine is in the build-out that continues, while everybody is watching the screen flash red and green. The engine is in the companies supplying the infrastructure of the next decade. The engine is in the quiet migration from AI as concept to AI as industrial system. And when I say industrial, I mean something much heavier than the way people normally use that word. I do not mean clever software. I do not mean viral demos. I do not mean one more app pretending to be intelligence. I mean land, chips, memory, power, networking, operating systems, enterprise lock, in cybersecurity, and eventually orbit itself. The market still talks about AI as though it were mainly a product category. It is not. It is becoming a capital cycle that distinction matters. A product category can get crowded, fashionable, and overhyped. A capital cycle eats balance sheets, supply chains, commodity inputs, and labor pools for years. That is how fortunes are built. When I look at the current environment, I do not see one stock to buy for growth. I see a layered map of where capital is already flowing, while the public is still emotionally trapped inside the latest conflict headline. And once you see the layers clearly, the whole thing becomes easier to act on. The first layer is fear itself. People laugh at sentiment indicators until sentiment gets so extreme that it starts creating prices no rational person would have offered under calmer conditions. Fear and greed are not decorations in the market. They are pricing mechanisms. When fear becomes widespread enough, assets do not merely get cheaper, they get temporarily separated from the patience required to own them. We can sell not because the business is broken, but because the feeling is broken. That is one of the most useful conditions in all of investing. I have always believed that fear is valuable if you treat it as a map rather than a mood. If a broad fear gauge has been trapped in extreme panic for weeks, that does not tell me the world is ending. It tells me the market has likely become more interested in emotional protection than in careful distinction. Once that happens, businesses that are still improving can be priced as though they are guilty, merely because the public is frightened. That is how opportunities are born. I am not saying buy anything red. I am saying watch what keeps getting stronger while the crowd is trying to de-risk its own feelings. That brings me to Nebius. This is one of those names that reveals exactly how slow the public can be when a new industrial wave is forming. A lot of people still think AI investing begins and ends with whichever giant model company or hyperscaler currently owns the headlines. That is an understandable mistake. Headlines love kings. Markets make a lot of money from landlords. Nebius is a landlord in the most important kind of neighborhood, which is sovereign AI infrastructure, regulated compute, and capacity that large institutions cannot simply improvise with a nice press release and a dream. If you are a bank, a defense contractor, a healthcare operator, a national government, or any enterprise whose AI usage cannot be casually parked inside somebody else's general purpose cloud stack, then you need something else. You need compute that is structured, secured, provisioned, and scaled with a very different level of seriousness. That is the business Nebius is moving toward. Now, what made me pay closer attention was not merely the company description. Lots of companies can describe themselves attractively. What matters is when giants begin placing huge sums of real money behind the infrastructure they say they need. NVIDIA did that, Meta did that, and these were not symbolic handshakes. They were the kind of commitments that turn a growth story into a capacity story. That distinction is very important. A growth story says someday demand may come. A capacity story says demand is here, and the harder problem is building enough physical and digital infrastructure fast enough to satisfy it. That is a much better problem. When a company can credibly say that multi-gigawatt deployment is coming, that next-generation platforms are already being allocated, and that major counterparties are underwriting years of forward demand, the market should not be arguing mainly about whether the category is real. It should be arguing about how much of the future cash flow is still unpriced. And that is why Nebius interests me. It is not the cleanest name. It is not the safest name. It is not the kind of stock you hand to a nervous person and say, "Here, sleep wonderfully." But it is one of the clearest expressions of the infrastructure phase of AI, where the value is no longer in talking about the possibility of demand. The value is in owning the thing that is bottlenecked, because demand is already larger than the system can comfortably service. I have made a great deal of money over the years owning bottlenecks at the right price. Bottlenecks are beautiful businesses when the broader wave behind them is not temporary. That is what I believe is happening here. And the public is still too distracted by war headlines to appreciate how large the capacity commitments underneath this story already are. The second layer is Microsoft, and here we move from infrastructure to embedded command. There is a phrase the market loves to use lazily, which is quality. Most people use it to describe stocks that have already gone up a lot and are popular with serious people. That is not my definition. A quality business is one that sits in the middle of an economic process so deeply that removing it would cost the customer far more than paying it. Microsoft is one of the great quality businesses ever built because it is not merely selling a product. It is sitting inside the working memory of corporate life. When I see Microsoft trading down toward a very long-term support level for the first time in ages, while revenue, gross profit, and earnings continue climbing at rates most companies its size cannot even pretend to manage, I do not read that as a broken business. I read it as a rare moment when price and quality stop moving together for a while. That is interesting. You have to understand how unusual it is for a giant company to keep compounding from such a large base and still be offered to you at a valuation the market would normally reserve for something much less central to the future. This is where Charlie Munger was always useful to me. He loved the idea that sometimes the best opportunities are not in ugly, forgotten junk, but in wonderful businesses temporarily offered at a rational price, because the market is busy getting sentimental about something else. The crowd usually makes one of two mistakes. It overpays for glamour or underpays for duration. When a company like Microsoft touches a long-term mean reversion line while the underlying machine remains one of the defining digital monopolies of the world, I think much more about duration than about the latest panic. Because what is Microsoft really? It is not a stock. It is a tax on enterprise continuity, cloud, productivity, security, infrastructure, software standards, developer ecosystems, identity management, embedded workflow, AI integration through the Office layer and Azure. A business like that does not need to win every headline cycle. It only needs to remain more costly to leave than to keep. That is a wonderful place to stand. When the market decides, temporarily, that the price should reflect near-term anxiety more than long-term dominance. I also think people are underestimating what happens when AI becomes less a speculative cloud over the market and more a feature integrated into existing enterprise systems. The public loves the idea of radical replacement. Radical replacement makes exciting content. Real enterprise value usually comes from enhancement inside the systems. Companies are already too embedded to abandon. That is one reason Microsoft is so dangerous competitively. It does not need to persuade the whole world to start over. It needs only to deepen the hold it already has. That is a cheaper and far more profitable game. So when I see a rare long-term buying setup inside a company that is still strengthening its financials while the market treats it like the second worst performer. In its peer group, I do not become dramatic, I become interested. The third layer is the networking and chip architecture spine. And this is where Marvell becomes much more important than most people appreciate. There are moments in a capital cycle when the entire market becomes so focused on the biggest name in the room that it forgets the ecosystem around that name can often become investable at more attractive prices. NVIDIA has become one of those giant suns around which everything else seems to orbit. Fair enough. But suns need systems, they need links, they need connective tissue, they need surrounding hardware, custom chips, optical interconnects, and the physical layer that allows all the compute glamour to actually function at scale. That is where Marvell begins to matter. When NVIDIA decides to pull another company into its inner infrastructure circle, I pay attention. Not because I worship NVIDIA, I do not worship any company, but because a company that sits at the center of a giant buildout is very good at identifying what pieces of the buildout matter most. When that company decides to integrate another player's technology into the broader architecture, it is telling you something about who gets to help build the roads, not just who gets to drive the flashy car. This is what the deeper Marvell thesis looks like to me. Custom AI silicon, high-speed networking, optical links, the kind of infrastructure most investors ignore because it lacks romance. I love businesses that lack romance if they sit at an important point in the flow of capital. Romance attracts crowds, utility attracts contracts, and then there is the celestial AI acquisition and the optical layer. This is one of those areas where the market can become very stupid because it hears a technical phrase and assumes it is niche. Silicon photonics sounds specialized. Good specialized layers are often where the pricing power hides when general demand explodes. If the next phase of data center design requires moving data with lower heat, lower power, and higher throughput than the old methods comfortably allow, then the winners will not merely be the names with the biggest branding budgets. The winners will be the names with the right plumbing. Marvell is plumbing, very profitable plumbing if the cycle goes where I think it is going. And because the market is still digesting the broad AI re-rating, you can sometimes buy infrastructure, plumbing businesses, before they get fully recognized as foundational rather than peripheral. That is where a lot of the best growth money lives. The fourth layer is the CPU war that most people have not properly priced yet. A lot of investors think the AI race is about who owns the largest training models or who sells the most glamorous GPUs. Those things matter. But industrial shifts almost always spread into adjacent bottlenecks. And one of those bottlenecks is the CPU architecture underlying data center, inference, and broader server workloads. ARM's decision to move from licensing architecture to launching a self-branded chip is not just a product announcement. It is a declaration that the company wants a different position in the value chain. It wants more direct participation. It wants not only to tax the ecosystem through licenses, but to step into the game itself. That is a serious shift. Now, I am not rushing to buy ARM simply because it made that move. In fact, I am cautious for a reason the market should not dismiss. Once you begin competing with your own customers, you introduce a different kind of risk into the model. Licensing businesses are beautiful precisely because they let other people do the heavy fighting while you keep getting paid. The moment you decide to become a fighter yourself, you may discover your old customers do not adore funding the company trying to replace them. That is a real tension. But even if ARM itself is not the cleanest immediate play for me, the broader lesson still matters. The data center AI race is spreading. Chips, networking, memory, optical links, inference hardware, server design, and deployment models are all getting pulled into the same expanding industrial cycle. That makes me even more confident in the picks and shovels approach, because whenever an arms race broadens, the suppliers of the battlefield often become more interesting than the generals shouting into the cameras. The fifth layer is one of my favorites because it shows what happens when private technical power collides with public fear. That is Anthropic, Broadcom, Google, and the cybersecurity complex gathering around them. Most people still treat the AI model companies as if they are mainly a competition over chatbots and assistant personalities. That is a childish reading of what is happening. The serious money is not in whether one model writes prettier paragraphs. The serious money is in whether these systems become infrastructure for decision making, security, code, enterprise workflow, and state-level defensive capability. That is why Anthropic's growth matters so much. A business does not leap from almost nothing to a revenue run rate that places it above most of the companies in a major index unless something very significant is happening underneath. That kind of acceleration tells me we are no longer talking about novelty demand. We are talking about institutionalization, and the compute deal matters even more. You do not secure that sort of capacity because you want optionality for a nice future. You secure it because you believe the demand is not only real but likely to be enormous, and because you fear what happens if you do not lock the supply in first. That is industrial behavior. Now bring Broadcom into the picture. This is exactly the kind of company I love in a capital cycle. It stands between the hyperscalers and the model makers with the kind of design, networking, and custom silicon capability that can become indispensable, while the public is still busy deciding which AI personality sounds smarter. In a demo, Broadcom is not dependent on one crown jewel winning the whole race. It gets paid when the race gets more intense and more hardware heavy. That is a wonderful place to stand if the build-out continues. And then there is the security angle, which I believe the market is still underpricing. If Anthropic's more powerful internal model is dangerous enough that it cannot simply be thrown open to the public, then you are no longer dealing with an AI story in the consumer tech sense. You are dealing with capability dense enough to create a new defensive perimeter around the major enterprises and infrastructure operators allowed to use it. That is why the coalition matters. CrowdStrike, Palo Alto Networks, Broadcom, Amazon Web Services, Cisco, Microsoft, NVIDIA. JP Morgan, these are not random logos for a nice slide deck. This is a map of who expects the next wave of AI capability to land first in security, defense, enterprise resilience, and system hardening. When companies like CrowdStrike and Palo Alto get access to advanced defensive tools before the broader market even understands the nature of the threat environment, these tools imply that is worth paying attention to. Cybersecurity was already important. The fusion of AI and security makes it even more asymmetric. The attackers get better tools. The defenders need even better ones. That is how category spending becomes structural rather than discretionary. And structural spending is what I want, not nice. To have software must have protection. That is why this layer fascinates me. It reveals that the AI capital cycle is already migrating into defense. Like enterprise categories where budgets do not depend on public enthusiasm, they depend on fear, necessity, and operational survival. Those are much more durable forces. The sixth layer is memory. Now, this is where markets often embarrass themselves because they hear one technical breakthrough and immediately assume the old bottleneck has been solved permanently. That happened when DeepSeek triggered compute panic. It happened again when DeepMind showed a compression technique that frightened memory investors. Markets love to hear efficiency and immediately translate it into less demand. But industrial history is full of the same contrary lesson. When a useful input becomes cheaper or more efficient, usage often expands so much that total demand rises rather than falls. That is Jevons paradox, and I think it matters enormously here. If memory usage can be compressed sixfold in one dimension, that does not automatically mean fewer memory chips get bought over time. It may mean AI inference gets cheaper, faster, and more commercially viable across far more applications. And if that happens, then the total amount of deployment can explode. The cheaper the machine gets to operate, the more people want one. That is not a new phenomenon. The falling cost of compute did not kill compute demand. The falling cost of storage did not kill storage demand. The falling cost of cloud did not kill cloud demand. They expanded them. So when I see the market panic about memory because one bottleneck may be managed more efficiently, I ask a different question. Does this make AI more affordable, more scalable, and more commercially attractive across the whole stack? If the answer is yes, then total memory demand may still rise, and perhaps rise violently. That is why Micron matters. It is why the new memory-focused ETF matters. It is why South Korean memory giants matter. It is why the category has become investable in a more organized way than before. Memory is no longer a sleepy commodity bucket to me. It is becoming an intelligence, enablement layer, bandwidth, latency, power, context size, model responsiveness, throughput. All of these things increasingly turn on memory quality and supply in ways the average investor still underestimates. I like that asymmetry. I also like what happens when a category that used to be dismissed as cyclical commodity supply starts getting reclassified as critical infrastructure. Reclassification alone can generate enormous upside if the earnings come with it. And in Micron's case, the earnings are not subtle. That matters. The seventh layer is perhaps the boldest of all, which is orbital compute and the broader SpaceX complex. I am not talking here about the romantic part of the story, though people always want to begin there. Reusable rockets, Mars, Elon's spectacle. The public loves those things because they are cinematic. I care about a different piece of it. What happens when the company that already dominates private launch, satellite internet, and now an integrated AI and social media adjacent ecosystem becomes a public market object? The answer is not simply that people can buy the stock. The real answer is that the entire category may get repriced. That is what most investors miss about iconic IPOs. The biggest money is not always in buying the main event after everyone has lined up to own it. A lot of the money gets made in understanding what the IPO validates for everything around it. If SpaceX becomes public in the form being discussed, the market will not merely be valuing a rocket company. It will be trying to value a platform for launch, satellite communications, AI connectivity, and eventually data center logic extending beyond earthbound constraints. Once a platform like that gets a liquid public price, it gives analysts, institutions, and thematic investors a benchmark around which the rest of the space economy can be organized. That is very important. Categories become more real once they get a flagship public valuation. And then there is the orbital data center idea. Most people still hear that and assume it belongs somewhere between ambition and science fiction. I no longer think that is the right way to hear it. The physical constraints on power, land, cooling, and permitting here on Earth are not imaginary. If a company is serious enough about long-term AI capacity to file roadmaps involving compute in orbit, powered by solar and linked back through satellite networks, then I do not need the idea to become immediate for it to matter. I only need to see that the companies building toward that future are already pulling semiconductor launch, networking, and manufacturing partners into their orbit. That is why Intel caught my eye in this part of the chain. Not because Intel has suddenly become a perfect company. It has not. But because when an industrial complex of that scale starts taking shape, even imperfect manufacturing partners can become very interesting if they own a piece of the capacity expansion story. The market loves redemption narratives too early and hates them too late. I prefer to examine whether the demand behind a redemption possibility is strong enough to matter before the public decides the story is cute. Again, if SpaceX AI, satellite infrastructure, and terafab scale chip ambitions really converge into one long-run industrial machine, then the suppliers, builders, and infrastructure partners around it will matter enormously. And again, most of the market is still too busy watching war to think this through properly. Now, you might ask what all of these layers have in common besides AI space and some frighteningly large capital commitments. They have one single thing in common that matters more than anything else to me. They are all parts of a world where the cost of standing still is rising faster than the public appreciates. If you do not own the infrastructure, you pay it. If you do not own the tools, you rent them. If you do not own the memory, you finance the system that does. If you do not own the security, you absorb the risk from those who built it first. If you do not own the pipes, you become the one paying the toll. That is why I always come back to the same investing question. Where is the toll? Not where is the story, not where is the biggest celebrity, not where is the loudest pitch. Where is the toll? Nebius is a toll on sovereign and regulated AI deployment. Microsoft is a toll on enterprise continuity. Marvell and Broadcom are tolls on the hardware and networking spine of AI. CrowdStrike and Palo Alto are tolls on AI age defense and cyber resilience. Micron and the memory complex are tolls on model performance and throughput. SpaceX and the orbital infrastructure chain may become tolls on the next layer of compute and communications itself. That is not a random basket. That is one single map. And when I see a map like that appear while fear is still dominant, while sentiment is still depressed, while big capital is already making long-duration commitments under the surface, I do not ask whether the market is comfortable. I ask whether the market is late. I think it is not late to recognize AI exists. Late to recognize that AI is no longer mainly an innovation theme. It is a capital deployment regime. Those are much bigger. Those last longer. They also redistribute wealth from people trading headlines to people owning infrastructure. That is where I want to be. Not because I enjoy uncertainty, because uncertainty is often the only condition under which the future is offered at a price that still leaves room for large gains. So when everyone is glued to Iran and the next ceasefire and the next overnight oil move and the next political shock, I am thinking about something else. I am thinking about what the world is already building while the crowd is frozen. I am thinking about what happens when extreme fear gives way to selective recognition. I am thinking about what happens when the public finally notices that the next great winners are not merely the companies with the most exciting demos, but the companies that own the rails, switches, chips, memory defenses, and orbital extensions that the demos depend on. That is where massive growth usually lives. Not in the center of the panic, just underneath it.